and to piggyback off of that, I wanted to bring in the concept of smart contracts. So I got a little video here I'll play real quick.
What are smart contracts? A smart contract is an application that runs on a blockchain network. Developers write these contracts, then deploy them to a public blockchain network where people can interact with them. Today, the leading smart contracts platform is Ethereum, but there are many others. Smart contracts are much like legal contracts, except instead of legal language defining the terms, code dictates the contract's terms. Unlike traditional contracts, which require a court to mediate disputes, smart contracts are self-executing, with the blockchain's immutability acting as a judge's ruling. Since smart contracts run on the blockchain, they are unstoppable with an auditable history, making them ideal for financial applications. Smart contracts are also flexible and can be used to build things like decentralized exchanges, tokenized assets, games, and much more. Many companies today have begun to take notice of smart contracts and their potential to build the economy of the future.
All right, so with that, the biggest thing I wanted to get out of the smart contract is it's immutable, it's permissionless, it's borderless, and it's code. There's no middleman, there's no human or entity to trust when it comes to the smart contract, as long as it's a deployed contract to the net and been audited to be, safe as far as what it's saying it'll do. But one thing that they said was a smart contract can power a decentralized exchange. And so we've seen how a centralized exchange works. There's buyers, there's sellers, and there's a market maker in between. Well, how can you make a decentralized exchange without having a centralized market maker in the middle? Well, the easiest way is with the automated market maker. An automated market maker is something that we see on Uniswap. I think Banker was actually the first exchange DEX to do it. Uniswap is the leader in the industry right now. I think they have 50,000 users a day or something like that. And then we got bees.social, the powerhouse, the best in the world, the most powerful force in crypto. I'm not biased at all, by the way, not biased at all. And then Balancer. Balancer did something really cool, and it takes a little bit of my brain power to wrap my head around that to start explaining it. So I'm going to stick with what Uniswap did. And Uniswap did 50-50 pools. And so essentially it's two assets, and they always have to equal 50% of each other. And the way that works, and you love my drawing, I tried to hand draw this, but I had to give up. But there's liquidity holders. So these are people that hold the asset. So say there's 1,000 people that hold Ethereum, and they want to earn money off of their Ethereum. Well, what they can do is they can stake that liquidity into a smart contract, and that smart contract works as a market maker. So the contract itself is a market maker. There's not an entity in the middle. There's nobody that can disrupt it. The contract and the code is the market maker. And the buyers and sellers can go into that contract and buy the asset they want and sell the asset they want. So essentially, there's I just got distracted. I seen that comment. I'm thinking if I'm using the wrong microphone. I am using the wrong microphone. Let me switch it. That's better. I wonder how that happened. But so the buyers and sellers, they at any time they can choose when to go in there. They don't need permission. That's the biggest thing that I want people to understand, is that it's permissionless. You don't need permission to go and buy and sell your asset. You don't need to be in a specific country or anything. It's borderless. There's no entity or country or anywhere geographically that this is restricted to. It is completely borderless. It's completely permissionless, completely decentralized. There's nobody in the middle of it. It's a contract living on the blockchain, and this contract in this liquidity pool is your market maker. It is your pool of liquidity to buy and sell your asset, and it's open 24/7. It doesn't shut down for technical difficulties. You don't get site maintenance down. It lives on forever. It cannot be altered. Once it gets deployed to the mainnet, you can't go back and change it. So when it is it's set out into the world, the worldwide wild, wild west of Ethereum land, it is set in stone. And so with a liquidity pool, that is your buyer, that is your seller, that is your pricing oracle. And in my opinion, I trust that a lot more than trusting a market maker from a centralized exchange, as far as my opinion would go. But what are the incentives? So as a liquidity holder, when you stake your liquidity in there, why would you stake your liquidity? Well, whenever there's a transaction from the traders, when the traders buy and sell, there's a transaction fee added to that of in Uniswap's case, 0.3%. So that 0.3% is distributed to the token holders of the liquidity pool. So that's very powerful in that sense, where you can make your money work for you. Instead of your money just sitting in your wallet and not doing anything for you, you can stake your capital into a liquidity pool and earn trading fees on it. So you became the market maker. And this is all done, like in the case of a centralized exchange, offering offering market making of buying and selling a stock price or buying and selling a crypto asset. You're not able to participate in that. But when it comes to decentralized, because there's no central institution or organization creating that market maker, then the people had to rally behind each other and bond together and create the liquidity pool. So they receive all the incentives. So the people bonded together, they put their money to work, and they're receiving the incentives. And then also the traders have a 24/7 buyer and seller. So I remember I was telling a story about Robinhood, and I'm sure they do a fabulous job and they have amazing technology, but the price of Dogecoin was collapsing, and it was collapsing fast a couple weeks ago. And they disabled buys and sells of that asset. So there's a lot of people upset when they tried to sell their Dogecoin because it was collapsing, that they couldn't because Robinhood disabled it. And so that's one reason why a smart contract or a liquidity pool is permissionless. You wouldn't need permission from the contract to sell your asset. And it doesn't shut down. They can't just decide 8 o'clock on Wednesday, we're going to shut down and I'll allow you to sell your asset. We're going to shut down on the weekend. You always have 24/7 access to buyer and a seller in a liquidity pool. Same with a story of E-Trade. I don't want to name, so erase that from your mind. But like a stock or a brokerage, when you try to sell your stocks or liquidate your stocks to get them back into your bank account, it's very difficult. It takes time. You have to clear it, and it takes 3 or 4 days or business days. Well, essentially with the smart contract, you can liquidate your asset whenever you want, 24/7, and again, permissionless. So I really want that to stick out, that it's permissionless. You don't need permission. It's your asset. Do with it what you want.
Got a question in here from Max. Can you explain the risks of these contracts to expose your funds to? Example of impermanent loss.
And I had that slide right here. So I had this slide right here. So a risk. So we've seen here these I don't know if you can see my mouse, but the liquidity holders, when they stake liquidity and create that liquidity pool, well, they can pull their liquidity out whenever they want. So that creates a risk if you're like, say a new token comes out and they name it XYZ token. And they say, oh, it's going to be the most amazing token in the world. Everybody go buy it. It's over here on Uniswap. And you go and buy it. And as soon as you buy it, the next day, all of the liquidity from that contract, the liquidity holders unstaked it and to put it back in their wallets. Well, now you have a token, XYZ token, that you can't sell. And that's something called a rug pull. So they staked their liquidity, you went and bought their token, and now you can't get out of that asset because they unstaked the liquidity out of that particular pool. So that's a risk right there. Impermanent loss. Impermanent loss, when you stake your, you even got it written up there. Let me read it. Impermanent loss happens when you provide liquidity to a liquidity pool and the price of the deposited assets changes compared to when you deposited them. The bigger the change is, the more you're exposed to impermanent loss. Well, so the way I understand it is, in order to keep the prices and correct with what the rest of the market is doing, like say the price on Uniswap for Ethereum is going to be different than the price of Ethereum on Coinbase. Price of Ethereum on Coinbase can be different than the price of Ethereum on Binance. So there's arbitragers or bots or traders that keep these markets in check. If they see a spread on an asset, then they will, go say Ethereum's $40 higher on Coinbase than Uniswap. They'll go and buy it on Uniswap and sell it on Coinbase. When they arbitrage that difference in the price, the holder of the asset that staked the liquidity, they missed out on that price decrease or price difference, but it's not permanent. That's why it's called impermanent loss, because it's only temporary. You make up for that on over time as the market comes into more correction and as you earn more trading fees. But that's something I need to study a lot more, so don't quote me exactly on how that works. But I wanted to talk the rug pull. So this is why M2 was so unique and so huge, is because M2 on day one, we look back here on day one, the smart contract, the liquidity pool for M2 was created, and $50 million on day one was deposited into that contract. And then the address that deposited that $50 million, because they deposited it, they could have unstaked it, right? No, because M2, the address that staked that initial capital, burned the keys. So that initial capital staked will never be able to be unstaked. It's in there forever. It's locked. It's locked liquidity. So when we talk about locked liquidity, that liquidity is locked in that smart contract forever. And so now we're up to $350 million in locked liquidity that's locked in that contract. And that means you have a $350 million buyer at all times, 24/7, holding your M2 tokens. So that's what's really special about M2 as far as them burning those keys. So burning the access to that capital from the initial address that deposited that $50 million. And I wanted to go over this. Why use a decentralized exchange? For everything I keep on talking about. It's decentralized, so you don't have to rely on any entity. You don't need permission. It doesn't matter if you're tall, short, white, Asian, Mexican, black. It doesn't matter. It's permissionless, and it's borderless. It doesn't matter where you're at in the world. You don't need permission. You don't need to be in a specific geographical area, and it's immutable. It cannot be altered once it's deployed, and trustless. You just need the only trust in there is trusting the code. But once the code is true, there's nothing that you need to trust. It's 100% trustless. And then also, the incentives. As a liquidity provider, your money is working for you. So when you stake your liquidity, instead of just letting it sit in a wallet, you can stake your liquidity and earn trading fees and all the traders that go in and out of the asset. And as a trader, you always have a buyer 24/7 and also without permission and completely decentralized.